You know what keeps me up at night? It's not the complex tax strategies or the ever-changing regulations. It's the phone calls I get from business owners in full-blown panic mode because they've just discovered they've been doing their S Corp payroll all wrong. I'm Tiffany Phillips, CPA and Tax Strategist, and I help business owners keep more of what they earn legally. Today, I'm going to show you the single most expensive S Corp mistake I see, how to fix it if you're already in trouble, and how to make sure you never lose sleep over payroll again. Just last month, I had a client, Sarah, who was practically in tears. She'd been running her consulting business as an S Corp for 3 years, making great money, taking distributions left and right, but never once paid herself a salary. Not once. And now she's terrified the IRS is going to come knocking. Here's the thing. Sarah isn't alone. I see this mistake constantly, and it's costing business owners thousands of dollars in penalties, interest, and sleepless nights. But here's what most people don't realize. There's a way to fix this mess, and there are strategies to make sure it never happens again. If you're even a little unsure about your S Corp payroll, you need to watch this video all the way through. Let's start with the basics because most business owners don't really understand why this salary requirement exists in the first place. When you elect S corporation status, you're making a deal with the IRS. I want to avoid self-employment taxes on my business profits, but I'm willing to pay myself a reasonable salary and pay payroll taxes on that salary. It's a trade-off. If you're a sole proprietor making $100,000 in profit, you're paying self-employment tax on the entire $100,000, about $15,300. But with an S Corp, you might pay yourself a $40,000 salary and take the remaining $60,000 as distributions. Now you're only paying payroll taxes on that $40,000 salary, saving you $1,000. But here's when people get into trouble. They think they can just skip the salary part and take everything as distributions. The IRS isn't stupid. They know exactly what you're trying to do, and they have specific rules to prevent it. The rule is simple. If you're a shareholder employee who performs substantial services for the S corporation, you must receive reasonable compensation before any distributions can be made. But what's reasonable? The IRS keeps this intentionally vague. They look at your training, experience, time devoted to the business, and what comparable businesses pay for similar services. There's no magic formula. Some advisors suggest the 60-40 rule. Others say 1/3 of net profits is salary. But here's my take. It's not about following an arbitrary rule. It's about being able to defend your decision if the IRS comes calling. Ask yourself, what would you pay someone else to do your job? If you're the CEO, marketing director, and janitor all rolled into one, you need to consider the value of all those services. And yes, it should be reasonable in relation to your company's revenue. You can't pay yourself $200,000 if your company only makes $150,000 in profit. So what happens if you don't pay yourself a salary? It's not free. If the IRS determines you should have been taking a salary, they can reclassify your distributions as wages. You'll owe not just the payroll taxes you should have paid, but also penalties and interest. You'll owe the employer portion of your payroll taxes an additional 7.65% on top of what you would have paid as an employee. Now you're looking at the full 15.3% self-employment tax rate you were trying to avoid, plus penalties and interest. On an $80,000 distribution with no reasonable compensation salary, the IRS could determine reasonable compensation of, let's say, $50,000 per year. By the time you calculate back taxes, penalties, and interest, you would owe over $45,000 a year based on IRS penalties, interest, and the timeline of when the IRS comes after you. And look, it's not just federal taxes. Many states have their own payroll tax requirements. And if you haven't been paying state payroll taxes, you could be looking at additional penalties and interest at the state level. Plus, if you're not paying yourself a salary, you're not earning Social Security credits, which could affect your future benefits. If you're sitting here thinking, oh no, I haven't been paying myself a salary, don't panic. There are ways to fix this. This is what I call the 1099 workaround. It's not perfect, but it's a one-time fix for past mistakes. Here's how it works. Your S corporation issues you, the individual, a 1099 NEC for the amount that should have been reasonable compensation for the prior year. You report this on your personal tax return as self-employment income, paying Social Security and Medicare taxes. On your S Corp return, you report it as officer compensation, reducing your business profit and adjusting your distributions. This isn't the proper way to handle S Corp compensation, but it addresses the main issue the IRS is concerned about, making sure you pay Social Security and Medicare taxes on your reasonable compensation. But once you do this workaround, you absolutely must set up your proper payroll moving forward. Whether you're fixing past mistakes or just starting your S Corp journey, you need to set up proper payroll. Here's how. Choose a payroll provider. I recommend QuickBooks Payroll, Gusto, or ADP. Make sure your plan includes automated tax filing and payments. Set up accounts with federal and state agencies. For federal, use your EIN. For state, set up withholding and unemployment accounts. Your payroll provider should guide you. Add yourself as an employee, enter your info, choose your filing status, and set your salary amount. Decide on payroll frequency. You don't have to run payroll every week or month. Quarterly is fine for many S Corp owners. The key is consistency and making sure you're paying yourself a reasonable compensation throughout the year. If your business isn't profitable, you generally don't need to pay yourself a salary. But if you contributed capital and then took it back out, the IRS might view that as a distribution, which could trigger the salary requirements. Let's talk about the most common mistakes I see. Number 1, taking no salary at all. If you're working in your S Corp, you need to pay yourself something. Number 2, setting your salary too low. The IRS won't buy that your services are worth $15,000 if your company is generating $300,000 in profit. Number 3, not understanding the timing. The IRS expects you to pay reasonable compensation throughout the year, not as a lump sum in January. Number 4, forgetting about state requirements. Some states are more aggressive than others about S Corp payroll compliance. Number 5, not keeping good records. If the IRS questions your salary, you need to be able to defend it. Keep documentation of comparable salaries, your job responsibilities, time spent, and the factors you considered. S Corp payroll doesn't have to be scary or complicated, but it does require attention and planning. The biggest mistake is ignoring this requirement and hoping it will go away. It won't. If you haven't been paying yourself a salary, don't panic, but don't ignore it. The 1099 workaround can help you address past mistakes, but you need to set up proper payroll going forward. If you're just starting your S Corp journey, do it right from the beginning. Choose a reasonable salary, set up payroll, and keep good records. The tax savings are real, but they disappear quickly if you get hit with penalties and interest for noncompliance. Here's my challenge to you. If you're an S Corp owner, take a hard look at your payroll situation this week. Are you paying yourself reasonable compensation? Are you running payroll properly? If not, make a plan to fix it. If you want to dive deeper into tax saving strategies like this, grab a copy of my book, Your Biggest Expense, at yourbiggestexpense.com. It's packed with strategies to help you legally reduce your taxes and keep more of your hard-earned money. Plus, you'll get access to bonus material to help you implement these strategies in your own business. Don't let tax confusion hold your business back. Take control of your S Corp payroll, implement these strategies, and start building the wealth you deserve. If you found this video helpful, hit that like button, subscribe for more tax savings tips, and drop a comment if you have questions about your S Corp payroll or want to share your own experience. I read every comment and often turn them into future videos. Until next time, keep more of what you earn, and remember, you've got this.